don't time the stock market. And what do I mean by don't time the stock market? Don't try to buy when you think the market has bottomed. Don't try to sell when you think the market has got its peak. The old adage is time in the market over timing the market. The stock market has 52 weeks that it trades throughout the year, and by statistical standards, only 10 days out of those 52 weeks actually propels the market up or propels the market down. And if you're not invested in one of those 10 days, you're not going to get all the gains and you're not going to get all the losses of being in the stock market. That's why it's so important for you to not time the market. Remember back to 2008, the Great Recession. The stock market was down over 50%. $3.4 trillion worth of retirement investing accounts were wiped out in that 15-month period. $3.4 trillion in retirement savings, hard-earned retirement investing accounts gone. Home values in some parts of the country were down 80%. That recession hurt. But here's the thing. If you would have stayed invested from 2008 to 2021, you would have been handily rewarded. Think about it. If you would have stayed invested in 2008, where's the Dow Jones Industrial Average today? Where's the S&P 500 today? You would have made your money back hand over fist. Stay invested. Don't time the market. Turn stock market chaos into opportunity. Look for opportunities in the stock market. Remember point number one, you're going to stay invested. Now we want to look for opportunities. Maybe you're still working. Maybe you're going to retire at the end of the year. Well, if you're over 50 within your 401k, or if you're investing in an IRA or a Roth IRA, you have the ability to do a catch-up contribution. What is a catch-up contribution? The IRS says, hey, because you're older, we'll allow you to put more money into your retirement investing accounts to give you a leg up because we know you're going to be retiring soon. So if you're already maxing out your 401k, your 403b, your IRA, your Roth IRA, look for ways to put more money into those accounts. Maybe if you don't have any more money to put in your 401k or your IRA, look for money to go into your brokerage account and now take advantage of stocks, ETFs, or mutual funds when they are lower. At the time of this recording, the S&P 500 is down about 22%. That means that you can buy VOO, which is the Vanguard S&P 500 ETF, 22% below its all-time high. Seems like a good deal to me. And even if the market goes lower, you still bought it on sale. So think about it. If there's opportunities out there, now I'm not telling you to go be super risky and buy some biotech company that's in the pennies. No, I'm telling you to do your research, look for high quality companies, look for high quality ETFs, preferably passive indexes that are going to be low cost and they're following maybe the Russell 2000, the S&P 500, maybe a dividend index, and get those ETFs, mutual fund stocks at a discount so that when the market comes back, you're making money hand over fist because you invested when the chaos erupted. Think about 1987. When the Dow Jones had its worst day in the history of the Dow Jones Industrial Average. If you had invested on that day, you would have made 50% over the next 2 years. If you had invested on the worst day of the Dow Jones Industrial Average, when everybody was screaming, you made 50% on your money over the next 2 years. If you had invested in 1982, the end of one of the longest recessions in our history, if you had invested money in that year, again, a bad year, you would have made over 60% the following 2 years. So, turn chaos into opportunities.